Welcome back to today's lesson where we are going to talk about advanced variance analysis, but today we will talk about variances of what? Sales. We've covered labor, we've covered materials, now we want to cover what? Sales. We want to cover sales. Your sales variances, we normally have one sales price what? Variance, which we introduced again previously. And your sales price variance is a variance of actual quantity. This is actual quantity sold. Remember, this is actual quantity sold because you're dealing with sales. The standard selling price minus your actual selling price. So SP means your standard selling price or your budgeted selling price. Selling price. AP means your actual selling price. Your actual what? Selling price. Then sales volume variance, which is SVV. Now we have two approaches of calculating volume variance. We have using absorption costing, and when you're using absorption costing, we use what? Profit. So your sales volume variance will be your standard profit budgeted quantity minus actual quantity sold. Then we can also have using what? Marginal costing. Marginal or contribution costing. Using marginal or contribution costing, your sales volume variance will be your standard contribution margin budgeted quantity minus actual quantity done what? Sold minus actual quantity sold. Now these variances of volume can further be subdivided into other two. Number one, you can have mix by sales mix and sales quantity variances. So let's start with, say that your sales volume variance, SVV is equal to your sales mix variance plus sales quantity or yield variances. Right. We can start with that variance known as what? Sales what? Mix variance. Let's start with the sales mix variance. And the sales mix variance can only be computed when and only when you have what? Different what? Quantities of raw materials, of not raw materials, of units being produced and sold. So your sales mix variance it should be your standard profit or your standard contribution. Sometimes standard contribution, but your standard contribution you use what? When you're using marginal costing, it should be your mix is given by actual quantity in standard what? Mix minus actual quantity in actual mix. In actual mix. All right. Sales quantity variance SMV, again depending on whether you're using what, marginal or absorption, you will either have to use your profit or your contribution. Standard quantity in standard mix minus actual quantity in standard what? Mix minus actual quantity in standard what? Mix. Right. That is how you determine that. Yeah. We can go to a question. We can go to a question on April 2022. April 2022. Let's go to April 2022. Let's go to April 2022. April 2022. Question 3B. Question 3B. Question 3B. It is also important to highlight what this means. Before we forget, that is your budgeted quantity. That is your actual quantity. I think all the other items we have them. Now this standard quantity in standard mix basically means it is your budgeted quantity there. So let's have that as your budgeted quantity. Your budgeted what? Quantity. Right. April 2022 question 3B. April 2022 question 3B is the question I want us to look at today. The saying, Dominion Beverages Limited makes and sells two beverage products branded Bingo and Boost. The budgeted sales profits for the year 2021 are as follows. You have your product, your sales in units, and your revenue, your cost, and your profit. Actual sales were as follows for Bingo and Boost: to 8 units with a profit of 5.3, 630 units with a profit of 2.8. The company's management is able to control the relative sales of each product through the allocation of sales effort, advertising and sales promotion expenses required. Calculate and interpret the following. Number 1, sales margin, price, variance, sales margin volume, variance, sales margin mix, variance, your sales margin quantity, variance, and your sales margin total, variance. Now your total variance simply is the summation. Just indicate that. It is simply your sales price variance plus your sales volume variance. Simply the total of that. Right. Let me have this question here. You will have your products, your sales in units, that is your sales quantity in units. You have the revenue in shillings, your costs in shillings. You will have your profit in total in what? Shillings. You have two products, Bingo and who? Boost. How many units did you sell? 400 and 300. That means in total you sold 700. This is your budgeted. Your revenue was 8,000, 12,000. So your total revenue is 20 what? 1,000. Cost is 6,000. 11,100. 17,100. Your profit or your budgeted profit was 2,000. That is 900. So that your total profit is how much? Total budgeted profit is 2,900. Then your actual sales. Bingo was 280 units with a profit of who? With a profit of 5.3 per unit. Boost 630 units with a profit of who? $2.8 per unit. 2.8 per who? Per unit. We can start with the first variance, sales margin, price, variance, the first part of that question. Your sales margin, price, variance, you're going to say what? It is your standard what? Your actual quantity sold, your standard selling price per unit minus your actual selling price per unit. In this particular question, we had two products, the first one being who? Bingo, and the other product being who? Boosts. Being Boost. Your actual quantity sold was how much? 280. To bracket this this SP here, since it is what? For margin, they simply wanted you to realize that you're supposed to use what? A profit. You're supposed to use your what? Profit. So let's get your profit per unit. Profit per who? Per unit. You're going to take 2000, divide by who? By 400, 900, divide by who? 300. That is 5, that is 3. So your standard profit is 5. Your actual profit here is what? 5.3. 5.3. For boost, 630. 3 minus who? 2.8. Now let me clarify and say, in this particular question, the actual values here, we've not been given the revenues. So there is no way we can determine our what? Our selling prices here. We've only been given what? Profits. So that is what we're going to use. But in case we had been given what? The revenues here of the actual sales that were made, we would have determined this price variance by taking your actual quantity sold, your selling price, your standard selling price minus your actual selling price. But you're saying, because we don't have our what? Selling prices here, we only have our what? Profit for actual sales. There is no way we can use our what? Revenue, our profit here, or rather there is no way we can use our selling prices here. Okay. Now, so let's analyze this variance. 280 to bracket 5 minus 5.3. This is 84. Times 630. That is 126. Then we need to analyze whether it is favorable or adverse. This is favorable. Why? It is you selling, or this is a profit you're earning. In fact, this is a profit. You had budgeted to earn a profit of 5. You have ended up with a profit of 5.3. Favorable. This will be adverse. Why? You had budgeted to earn a profit of 3. You have ended up with a profit of 2.8. That is not good for the organization. Your profits have reduced, therefore that will be 42 what? Adverse. 42 adverse. Okay. The next variance that they want us to determine, number 2, is your sales margin volume variance. Sales margin volume variance. How did we say you get that? You're going to take your standard profit, budgeted quantity sold minus actual quantity done what? Sold, minus actual quantity sold. Okay. You have 2 products, Bingo and who? Boost. Your standard profit was 5. And this was 3, that is your standard profit. Your budgeted quantity sold was 400. Compare this with an actual quantity sold of how much? 280. Budgeted quantity sold was 300. Compared with an actual quantity sold of how much? 600 and what? 30. 630. So 5, 400 minus 280. This is 600. 300 minus 630. Let's see whether we have whether it is favorable or adverse. It is you selling, so that will be adverse because you've reduced your volume of sales from 400 to 280. This, you have increased your volume of sales, so that should be what? That should be favorable. That should be favorable. $390. Which you're going to say is what? Favorable. That is what? Favorable. So your sales margin total variance, we will look at it, but it is basically the product of these two. We'll come to it later on. Let's go to the third part. The third part where they're asking for what? They are asking for your sales margin mix variance. Sales margin mix variance, which is your standard profit. Your actual quantity in standard who? Mix minus your actual quantity in actual mix, or simply your actual quantity, or simply your actual quantity. Okay. We need to identify our actual quantity sold is here, but you need to identify your actual quantity in standard what? Mix. So let me write this here. Let me write it here. Actual quantity in standard what? Mix. Nine, 10. Now, your actual quantity in standard mix is simply telling, or simply requires that you share this actual quantity using the ratio of your standard mix, and your standard mix is here. Okay, so for bingo, you're going to take 400 over 700 times who? 900 and who? 10. 300 over 700 times who? 900 and who? 10 times 910. $520 is your actual quantity in standard mix. $390. So that you'll have sold how much? 910. So bingo, your standard profit per unit was 5 and 3. For boost, your actual quantity in standard mix 520, and this is how much? 390. Your actual quantity in actual mix is simply the actual quantity you sold, 280 and 630 and 600 and what? 30. 1200. $720. Then see whether it is favorable or adverse. So actual this is quantities, so this should be adverse. This should be favorable. That should be favorable. Okay. The other variance they are asking for, that is your mix variance. Part 4, they are asking for your what? Your sales margin quantity variance. Your sales margin quantity variance. Sales margin quantity variance, which will be your standard profit. Your budgeted quantity, standard what? Mix minus actual quantity in standard mix. Standard what? Mix. Let's start with bingo. Boost 5 3. Your budgeted quantity, basically it's this budgeted quantity you sold or you had budgeted to sell, okay, in standard mix. So 400, 300. Your actual quantity in standard mix, we've calculated it here, 520 and 390. $20 and what? 390. 400 minus 520, 600. 300 minus 390, 270. Favorable. 870, which you're going to say is what? Favorable. Now that we have calculated our sales margin quantity variance and our sales margin volume what? Variance. Let's confirm that when you take your volume, your mix variance plus your sales quantity variance, it will give you your what? Your sales margin volume variance. So we say your sales margin mix variance plus your sales margin quantity variance will give you your sales margin volume variance. Your margin mix variance is 480 adverse plus your sales margin quantity variance of 800 and what? 70 favorable will give you a volume variance of how much? 390 favorable. 390 favorable. Right. So those two answers should give the same. So that means we are correct. We have indeed proved that. Number 5 was your total sales variance. Total sales variance, which is the summation of your price variance plus your volume what? Variance. That's your volume variance. Your price variance your price variance is your 42 adverse plus volume variance of 392 favorable. So therefore this should give you 348, which is what? Favorable. 348, which is favorable, right? Those are variances of sales that we have successfully done what? Tackled. Remember, I've told you, under normal circumstances, absorption you use profit to get your what? Your volume. And marginal you use your contribution. And you know, remember, contribution is simply the difference between selling price per unit and your total variable cost. All right. This April 2022 question 3B is an exemption to that. Why? Because you have what? You have profit. You don't have the selling prices for to calculate your sales price variance. Right. And with that being said and done, in the next lesson we will talk about advanced variances of fixed overheads. So from my part, goodbye and see you in the next session.